The Federal Reserve has laid bare its internal divisions. Even after lowering its benchmark interest rate, many policymakers are sounding cautious, worried that cutting too soon could derail the fight against inflation. At its meeting October 28th and 29th, the Federal Open Market Committee, FOMC, voted 10-2 to cut the federal funds rate by 25 basis points, bringing the target range to 3.75 to 4%. However, the minutes released today reveal that the decision was far from unanimous. Many participants warned that while inflation has been above the Fed's 2% goal for 4.5 years, progress is stalling, and they feared that further cuts might signal a loss of commitment to that target. Most policymakers also voiced concern that cutting rates too could risk inflation becoming entrenched. At the same time, others were more focused on possible job market weakness, creating a rare three-way split within the Fed. Some saw a December cut as likely, some saw cuts as appropriate, but not necessarily in December. Many participants had already ruled out a December cut, meaning a minority supports immediate further easing. To complicate matters, the job data and inflation reports that normally inform Fed decisions are delayed due to the recent shutdown. The Bureau of Labor Statistics announced that employment reports for October and November will not arrive before the Fed's December meeting on December 9th and 10th. As a result, market expectations for a December rate cut have plummeted. Traders assign roughly a 25 to 30% chance of a cut in December. Following the release of the minutes, US stocks and gold paired gains while Treasury yields edged higher. For markets, the longer inflation stays above target and the less data the Fed has had to work with, the greater the uncertainty. And that can spook equities and bonds. For borrowers, businesses and consumers, if the Fed holds off on further cuts, borrowing costs remain higher for longer.